Okay, hi everyone, and welcome to the first webinar of 2024. Now, I'm joined today by two very special people, but before I introduce them, I'm just going to give a very quick overview of Shojin while I can see lots of people are still dropping in to the webinar. So let's just begin with that, and then I'll come back and make some introductions. So for those of you who are new to Shojin, just a very quick background. Shojin is an FCA-regulated real estate investment platform. We enable investors to invest into real estate development projects on a fractional basis. So that means investors can invest from £5,000 into a variety of projects. We specialize in providing funding for UK real estate development projects in the residential sector, including things like student accommodation and build to rent sector, and typically for projects worth in between 10 and 60 million pounds. So traditionally, it was very hard to get exposure to this sector for an individual, but now through Shojin, you are able to get access to these type of projects, knowing that Shojin is carrying out all the due diligence and monitoring of the project on your behalf. So there's lots of information online if you'd like to know more about Shojin, but for now, I'm going to stop there and I'm going to introduce my panel. So I think you can see me properly. I'm just going to make a quick adjustment. There we go. Right. So I am joined today by Jacky Chan. Welcome. Jacky has about 15 years of experience in the real estate and finance market. He's done over $4 billion of transactions in both the private and public markets. He's got previous banking experience as the head of real estate at an investment bank, as well as experience with various other firms, including Morgan Stanley, Deutsche Bank, various family offices. And he's got experience with real estate in Hong Kong, China, Canada, and the UK. So some super experience there. And he's just joined us probably, 3 months ago?
Yeah.
3 months ago to really engage with investors and help answer questions about the various projects and really help to scale and grow the business. We are also joined by Kirat. Welcome, Kirat. Kirat's background is, again, private banking. He spent quite a while with Standard Chartered before moving on to working with various family offices. He's got over 10 years of experience in origination, structuring, capital raising, and private equity. So Kirat has, we've known Kirat for a short while now, and he's properly started with us, just
about a week and a half ago.
About a week and a half ago. So quite new, but with phenomenal experience. So once again, just like with Jacky, Kirat's going to help work with our investor base to answer questions and to help grow Shojin into a fully international brand. So to both of you, welcome and thank you for joining me today. Now, we will jump straight into it. The idea for today is we're just going to have a general conversation about what's going on in the markets, really to get a better feel, and especially for our investors all over the world, just for everyone to really understand what's going on in the UK market, in the real estate market, and in particular in the type of real estate projects we at Shojin are covering. Now, throughout this conversation, you are welcome to ask questions. The chat function is enabled, so just pop your questions on there. And thank you to all of you who sent questions in advance, and we will get to them. We'll probably cover some of them off anyway, but any other questions, feel free to put them on there, and we will get to them towards the end. And I know previously we had some issues with the mic. If anybody has any trouble hearing us, please pop it onto the chat. So let's jump straight into it, gents. Let's start by talking about something that's on everyone's mind. This has been one of the most painful things of the last, 12, maybe 15 months, maybe a bit longer. Inflation, right? What's going on with inflation? Who wants to pick this one up?
Well, so let me just start. So we're talking about two separate issues. When we're talking about consumer price inflation, that's sort of what we can see on the high street, when we're buying groceries and everything else. And then there's sort of real inflation in financial terms. There's usually a lag effect. So we're seeing inflation peak and dip. There will be a lagging effect once that hits consumer price inflation. In real inflationary terms, well, we've seen it peak. We feel like it's going to drop considerably, hopefully, in the coming months. In the next 24 months, we hope to see significant changes. Yeah, that's sort of where we are.
Well, if I may just share a graph that was put together. So, Jacky, what can you tell us about?
Yeah, and I think in real estate, like inflation is very important. Like I think in the back of everybody's mind, main two things that hit. Number one is because it affects the interest rates, because the Bank of England has a target of containing inflation at a 2% target.
That's the dotted line at
Correct.
the bottom.
That's the dotted line at the bottom there.
Okay.
And that's why inflation is important for real estate. As we all know, interest rates is very critical in real estate because of the financing involved in the whole real estate market. The second thing that inflation is important is because of the construction costs of development projects. Because if inflation is uncertain, people don't know how much to price their contracts. Costs could overrun. Developers are hard to contain their costs and estimate their budgets. So that's also another reason why inflation is very important in the real estate market. And also at the same time, that's also why Bank of England has an inflation target, because so that businesses can get on with their business. At a budget that they can actually predict.
Yeah.
So that's very important. And that's why for us in the real estate market, we always have to look at the inflation and the interest rate. So that goes hand in hand most of the time, because that's how Bank of England manages the economy.
And again, looking at the chart, this was one of the issues over the past couple of years, right? Which is developers, they got their funding to carry out projects. But because of inflation, a lot of their input prices started shooting up. And even though they had fixed price contracts with contractors, we all know what happens when contractors can't kind of deliver on the fixed price contract. Contractors go bust.
Yeah.
So we have seen a lot of that. But what's quite good is the fact that it has been dropping down. Now, again, if I'm not mistaken, last month it was at 3.9. This month there was an uptick to 4. So is inflation rising again?
It's not a linear trend. You're going to see sort of peaks and troughs every sort of now and then, but on an overall basis and on a relatively sort of longer time scale, we're expecting it to go down in simple terms. And that's how we're predicting sort of the next 12 to 24 months sort of track forward. And on that basis, where it's a rosier outlook.
And it's also, inflation is kind of now compared to 12 months ago, right? Yeah. So we've already seen the big spike. So it's, it's almost like it's not going up much more from there. And as the historical data falls away, inflation figures naturally fall. So
and I think the important bit is that it's not keep on going up or keep on going down, that it's stabilized. Because that's when people can understand how to price their budgets, how to carry on with business. If we roll back like 12, 24 months ago, what we feared about was that inflation was 4% this month, 5% next month, 6% next month, 8%, 10%. So where is it going next month? So what happens is everybody starts to jack up their prices in order to protect themselves. To make sure that they don't underquote in their
so they almost increase far too much, right?
Exactly. And they don't know when.
Market sentiment. That's exactly right.
And that will go into a spiral, because once you start pricing higher, and then the next guy will need to price higher to factor in your prices.
Right.
And that's where the inflation spiral, and that's what the Bank of England is always the most concerned about. So what's important right now is that we've seen inflation halved, at least. Like that's where the government has the target halving inflation, meaning that it's all back under control. And that's the most important part.
Now, you interestingly, you mentioned the Bank of England in that, right? Because remember, when inflation is getting out of control, you know, the Bank of England tries to step in to control it with the only well, it has a couple of tools at its disposal, but the key one is interest rates. So interest rates obviously shot up. I mean, a lot of people, I mean, you know, we do have some younger investors. And for a lot of people, it was the first time they've ever seen rates that were not close to zero. But the reality is anyone who's as old as, well, I was going to say us, but you two are probably younger than me, but anyone who's as old as me knows and remembers times when interest rates were 4, 5, 6%, you know, 80s, 90s, and early noughties. So, you know, the current level of interest rates is now coming to be almost accepted. But what do we think about the future of interest rates, given that inflation is now settling down? What do we think is going to happen this year or next year?
As a blanket statement, we expect rates will go down in the coming months and, you know, years. What that will eventually look like, we're still speculating. It's early January, where we're kind of waiting to see the sort of data output from the end of last year. Based on the last quarter, we expect significant movement. I mean, a lot of that was driven by sort of, well, let's talk about foreign capital for a second. You know, last year was a relatively sort of dry year as far as foreign capital coming into the UK. We expect some of that to change in 2024, 2025, where foreign capital will sort of look to reinvest. And that's a key driver of economic growth.
Okay, good. But if we're getting the growth, which hopefully doesn't stoke inflation,
yeah,
you think rates should come down this year?
I think so.
Let me put you on the spot. Where do you think rates will end the year? Base rates
down at least 100 basis points.
Ooh, that's fairly bullish on that. What about you?
I think it will come down slightly, but more of a gesture. Like probably, I would be a little bit more conservative. I would actually think that it's probably going to be a quarter to half percentage points. Just like, I think, because I think the government want to, or the Bank of England want to show the gesture that it has peaked, so that economy can go on again. But then at the same time, they will be concerned about whether stoking inflation again, so they don't want to go too far.
Yeah.
So I am a little bit more conservative on that front. But also I want to add as well, Jatin, you made a very good point on, like, last 5-10 years it's been zero interest rate, and now it's 5 and 5.25. I think it's very important to understand, like, it's not necessarily a bad thing having a 4 or 5% interest rate. And we remember back in the days when why it was 0% interest rate, it was because the economy was really bad.
Yes.
That was why they went into QE. That's why they cut interest rates to those levels. So having a positive interest rates is not necessarily a bad thing. Like, what happened was the change, or the magnitude of the changes in interest rates. That's what hits businesses and hits asset prices and all that. So as long as, like, because if you think about it, like, having an interest rate means that your money can put to use and generate a return. Like, if you think back in the last 5-10 years, like, everybody has been thinking, oh, where should I put my money? My money, like, is not generating any returns at all. And then everybody has to chase after bad deals, whatever deals it is, just chase after it just in order to generate a return. So I would actually be a little bit contrarian and think that, like, having a bit of a positive interest rate isn't actually a bad thing, as long as things are stable. I think the economy will adjust itself. Just don't stoke it either way, massively, like, and then people carry on with their businesses and will adjust accordingly.
Well, they talk about a natural level, right? That they, you know, I mean, we have a natural level of inflation, or a target of 2%. You know, you'd say, well, why isn't it zero? Because you always need a little bit. And in the same way with interest rates, there's a natural level of around, what is it, around 4.5% thereabout. In fact, I think we have a chart. Let me bring up the chart about where interest rates were expected to go. So this is from the Bank of England. You know, smart bunch. and they're kind of projecting where they think base rates will go. You can see that they're actually expecting it to be at, what is that, about 3.25 sometime in 2026. I think that's quite low.
Yeah.
I'll be surprised if it gets that low down, but I don't know. Are they expecting the economy to be worse than maybe I think? Is that why they're expecting rates to come down more to boost the economy?
Well, I mean, it's worth talking about sort of the political situation now, because remember, we're coming up to an election year, or a general election. And historically, they've always sort of tried to drive growth, well, when there's been an election. And part of that is either side just saying, hey, this is what I'm going to do for you, and here's what I'm going to do to help. And they want to see that growth metric sort of track up. And, we're coming
But
up.
then the Bank of England is supposed to be independent from any
Well, let's go back
political
to
party,
real
right?
data. I mean, if you talk about general election years, they've historically been good years.
Okay.
Now, they're absolutely independent parties, but, the
Interesting.
data sort of tracks
Interesting.
another way.
Conspiracy theory.
Yeah, I would add that also Bank of England probably also looks at the inflation target that has come down at 4%. And also a very key factor they will take into account is the real interest rate. What it is, like real interest rate, meaning that the interest rate, the base rate, the nominal interest rate minus the inflation. So I think that's also a very important figure that they look at. So if they expect inflation to come back down to 2%, even an interest rate at 3%, they're still in a comfortable territory of a little bit positive. So I think it's also a matter of, if you think about it, it's just like, inflation is going at 2% a year, and you want your money to beat your inflation so that it doesn't erode your cash.
Yeah.
So it is always healthy to have interest rates slightly higher if possible. Like obviously it's not never that easy to have that, but I think it's so that everybody's money is actually earning a little bit more than inflation and not being eroded by inflation. So I think that's how they are also looking at it.
But then during the last, I guess decade, you did have a situation, right, where inflation was actually higher than interest rates. And so actually, if you left £100 in the bank, by the end of the year, it was worth less money.
Yeah.
You want to avoid that.
Yeah.
I mean, we're talking from sort of a real estate perspective. So just coming back to that, real estate's always been sort of an inflationary hedge.
Yes. So good point. Yeah.
That's also sort of going to be a draw of capital preservation, as well as sort of looking ahead.
Yeah.
Rental prices are pegged to, inflationary targets, and we're going to see sort of what that looks like coming forward.
Yeah, well, actually, before we get on to, because you're absolutely right, historically, it's always been considered that in inflationary times, you want to be in real assets, because you're not, basically money becomes worth less. So the real estate values go up, and therefore, basically, you're always in a good position because the asset still has value. And that's why people go to
and then your
gold,
contracts.
right?
Remember, your contracts are pegged to the inflationary targets. So whenever you're up for renewal, it's a pricing mechanism that's pegged against a pricing target.
Yes, yeah. You might have an RPI linked
there you go.
Income. But before we go into property prices and rental values, and what's been happening, let's just quickly, just to round off interest rates, right? It's now base rates are, they're at 5.25. They may or may not come down depending on who you listen to, and they may come down more or less. But actually, one thing we have been seeing recently is incredible competition in the lending market, in the mortgage market, which is great. And let's remember, how is it if base rates are at 5.25%? How is it that the bank can give you a mortgage at 4%, right? So, and I'm sure many of you already know how that is the case, but it does confuse a lot of people. So it's probably worth just touching on that. I mean, who wants to answer that question?
Well, because I think mortgage is a long-term loan, like the base rate is a short-term loan. There's the duration difference in between that. So banks price their mortgages, let's say a 2-year, 5-year fixed mortgage based on the same duration of the base rate. So in the treasury market, in the 2-year, 5-year market, the rates have actually come down because they're predicting that the base rate will not stay at 5.25 for long. So by the end of like 2 years later, 5 years later, it will be at lower, let's say 3% or even lower. So or let's say about 3-ish%. So that's where the market sees it, and that's where the banks will compete and price their mortgages accordingly.
So talk about the competition in the banking space. I mean, what we've really seen in the last, post-COVID has been the challenger banks sort of emerging from the space. And they have the ability to price more competitively because they have a lower sort of fixed cost. You've seen American banks sort of enter the UK and try to compete in the banking space. So they also have to sort of compete against each other for your business. And, that's kind of one of the drivers for some compression in pricing.
Yeah, so and that makes sense. I mean, you have seen it. I mean, if you go online right now and you're searching for mortgages, I mean, you have a gazillion options, and certainly taking both of your points, there are forward curves, right, which are looking at where interest rates are going to be, in 6 months, 12 months, 1 year, 2 year, 3 year, 5 years, 10 years, and so on. And so when banks are packaging up these mortgages, or when they're borrowing money, they're borrowing it against a longer duration, and therefore they can borrow at a cheaper rate than what the base rate is saying. So that tells you why rates can be below base rates. But the interesting thing is where the competition comes in, because this is where, what is the bank's profit on top of where they're borrowing in the markets? And this is, things like credit spreads and all of that comes in. And really, how much are they, how much of their profit are they willing to squeeze in order to gain market share? So the great thing about the UK, it is a very established, very highly competitive mortgage market, and long may that continue, right? Because for consumers, whether you're a homeowner or you're buying buy-to-let property, all this competition is great because you do get great deals, which is why traditionally, I mean, in fact, I think one of you guys mentioned that Labour's thinking of a 25-year fixed rate.
That's right. And then look, it's one of those products that what they're really trying to do is court the voter.
Yeah.
And you've got the Help to Buy schemes, you've got longer term mortgages. What they're really saying is step up on the property ladder.
Yeah.
And sort of add more so to the economy, and they're just trying to court you to help you to sort of get going.
But isn't there a danger? I mean, see, the reason, and this is my own view, and this is certainly not backed by anything, but the reason we generally liked shorter mortgages, 2 years, 3 years, 5 years, is because most of us play the real estate market, right? So if prices are going up, and I'm not saying they will go up indefinitely, but on average, since the Second World War, real estate prices have doubled every 10 years, right? So with all its ups and downs, on average, it tends to go up. Now, if you borrow money, and it's a very highly competitive market, you might only want to borrow for 2 or 3 years, because after the 2 or 3 years, you can refinance. And if there's more competition in the market, you could get a cheaper rate. So it depends where we are in the rate cycle. But also, if the values have gone up, you might fall into a different tier of mortgage. So instead of being in the 75% loan to value, you might be at the 60% loan to value, which gives you the benefit of a much cheaper mortgage. So there is an argument to say, well, why would you want to lock into such long terms? Now, when rates were close to zero, hell yeah, lock in for 25 years. When rates are close to 4 or 5%, is there any point?
I guess people appreciate the certainty, the sort of, this is what I'm going to get. And it's that level of assurance. It's more sentiment driven. And it's, okay, rates might go up, rates might go down, but this is what I'm going to pay.
Yeah.
And this is what I'm going to sort of, if it's an investment, so this is what I'm going to make against it. And
so it's a certainty factor.
It's a certainty. I mean, that's what it really is. And some people are pessimistic on the markets, and they could see this as sort of some level of protection against where they see the market's going.
So sometimes I think that it's a personal view again. I sometimes think that it's better politicians tinker less with the market. Just let the market decide what it is the best. Like the banks can offer a 25-year fixed, fine. Like if somebody bites, then somebody bites. Like the market will decide whether they actually want this product, right? So I think at the end of the day, it's like some people would want the certainty. Some people would want want to bet on the rates, make sure that like it might go down further. They don't want to lock in at a 25-year. So I think at the end of the day, like market knows best. Compared to the politicians. So I think the market at the end of the day will pick the right product.
But you see, I like your point there. Politicians should leave the market alone, right? But the reality is, so much of the UK's wealth is in real estate. Politicians have always tried to tinker with it in the background to try and get votes and so on. So while Labour's talking about a 25-year mortgage, the Tories are talking about a 99% mortgage for first-time buyers. This is, they used to have the Help to Buy scheme. Now they're thinking of bringing out a 99% mortgage. Now, from our perspective, it's great, but it's great because it means all the developments fly off the shelf. But from a general kind of if I put aside Shojin's interest and I just think about the broader interest, the economy, the market, the people, surely that's just going to stoke in inflation in real estate. It's going to push prices up.
And also not to mention the stress on the financial system, like because everybody will be so leveraged. So somebody had to pay at some point. Yeah, with all the leverage that has been put on. So yeah, that's why I always think that just let the market do its thing. Like these suggestions, I'm not sure if it really helps that much. Like it helps in a short term.
To be fair, the last time they left it to the markets, though, pre-financial crisis, a lot of you guys will remember this. We had 125% mortgages, right?
That is true. That is true.
There's always a slight correction every sort of now and then, which is why we always prefer to be on the debt side of things, because there's some level of certainty and protection. But look, either way, there are products out there that are attracting new consumers to the product class, to real estate. That's good for us.
Yeah. Well, look, it's definitely. I think right now, Milo, if they did bring in a 99%. I'd be all for it because I think Help to Buy was good. I think it really did help first-time buyers. And remember, while a lot of first-time buyers no longer really want to buy, because why do they want to be saddled with a mortgage? They want to be free. They want to travel the world. They want to, be digital nomads and all of that. But actually, there are still quite a lot of people that do want to buy property and settle down and so on. So I think it would help. But I'm gonna move on to then property prices. Now, let's just have a quick look at what's been going on with property prices. Let me bring up a chart. Thank you for guys that are putting on questions. Oh, actually, let me answer one of these questions. Well, let me ask one of these questions first. From Vasco, thank you. Do you think the large national living wage rise planned for April will cause inflation to rise again?
The rise and fall of inflation is a very sort of complicated metric. To simplify it, I don't think so.
Okay.
I don't want to.
Why? Won't that just? I don't know. Will that just pump more money into the economy? Will that not be inflationary in itself?
We want to pump more money into the economy because we've still got sort of the overhang where costs are still, they've stabilized, but to a certain extent, there is some increase in your cost base. So there's sort of a natural sort of marrying of the two numbers. And then it's on a sum basis against a whole bunch of other sort of factors. Do you think the rates are going to go up? On the level, I expect, in personal opinion, I expect they'll probably sort of track down.
I think, like, I think the rise in inflation or going back up is currently probably not market's main concern right now. I think market's concern a lot of the times right now, especially investors I've been speaking to, is whether they have over tightened. I think that's the chatter. I think in the market right now, have they over tightened? Like, is it going? Are we going into a recession? Because recession will even result in a deflation. So if we're not, then it is fine. So I think it's more like I wouldn't be too concerned about inflation being stoked up again at this point. And that's probably why the government and Bank of England and policymakers are basically now trying to make sure that they haven't over tightened. So
Yeah.
I wouldn't be too concerned about inflation going back up, but it's more like whether they have over tightened, is it going to affect unemployment and wage? Which we've got other charts that can show that it's been very resilient so far, which is positive.
Let's have a quick look at employment data, actually. Let's have I think we've got a chart for that. Unemployment, there you go. So, I mean, unemployment was really at an all-time low, wasn't it? Just after COVID. Crazy low, in fact. It was almost impossible to hire anyone because the people that weren't working didn't really want to work. So there was no one left. But the figures have kind of been moving up ever so slightly.
Stabilizing.
I mean, it's stabilized. Yeah, it's certainly not crazy.
And I think like the economy has proven it has been resilient. I think everybody, and every market commentator, probably no one saw that it could be that resilient with interest rates rising that much. And that is actually a positive thing. And I think that's where the government would want to keep it like that. It's still like an interest rate is still at 4-5%, 5%, 5.25%. And then unemployment hasn't really gone up much. Like it's stable, it's still relatively stable. That's, I think, where the Goldilocks scenario is. That's where I think that's where they wanted to.
Stability.
Stability, basically.
That's what everybody wants. Right? I agree.
We saw that when, some politicians tried sort of riskier maneuvers, especially on the conservative side relatively recently.
Oh, yeah?
Yeah.
Much in my brain.
Markets didn't appreciate the sort of shock and awe approach to it.
Right.
And I think sort of what this comes back to and what will likely sort of happen over the next year is, okay, let's all just take a beat for a second. Things seem okay, that aren't getting worse. Let's make.
Well, actually, I mean, look, you mentioned shock, right? I mean, look, we had crazy times with crazy Kwarteng, and then it all stabilized with Rishi. Now coming up to election, Rishi and Hunt are looking at tax cuts again, right? So tax cuts are inflationary as well. Inflation is higher interest rates. So is it kind of giveth with one hand, tax breaks or tax cuts, and taketh with the other, i.e., keep base rates higher?
This is why I like being in real estate. Capital preservation and structured growth.
Okay.
Rates go up. My contracts are pegged to
RPI.
And I'll see some uplift in years to come. Something crazy happens, I've still got a real asset out there with capital preservation.
Right. So you're not as badly hit. You're affected, but not crazily.
And then that's the goal. And that's why we talk more about real estate rather than other financial metrics.
And I look at it, I think the tax cuts, fiscal policy, monetary policy, there's always this debate. I think the interest rates, most important is keep prices stable so that everybody can get on with the business.
The Bank of England is independent.
Supposedly.
And tax cuts or so-called tax reforms, I think it's also very important to make sure that the tax system is incentivizing people to work, incentivizing people to work harder or
to work and reinvest capital.
Reinvest capital, like so that the tax tax cuts needs to be.
Apologies. Live TV.
So that the tax makes sense in the whole economy and it grows the economy. So that's what they call the real economic growth. So it's not driven by simply prices going higher, but actually people being more productive, doing more work, doing more productive work, creating more for the economy,
and hopefully reinvesting and helping things to grow. And So you know what? It's interesting because you mentioned stability, right?
Mm.
Both of you mentioned the stability. So I'm going to go in and let's have a look. Let me find another interesting chart because let's look at why is this in the way? Rental values, right? Now we talk about stability, and stability would be great, but rents have been absolutely shooting up. I think last year was it 14%? Was it 14% nationally or something? Something like was it 12% in London and 14, 15 nationally? Crazy increases, right? And we know the reason. And it's something I keep harping on about. So for those of you who've watched these for a long time, I do apologize, but supply and demand, very, very simple. We are about 4.3 million homes short in the UK right now, due to 30 years of underdevelopment. That's what's supporting house prices, and we'll look at prices in a second. But the sad thing is that rents are shooting up because of everything that's happened in the last few years. The government decided to withdraw a lot of the benefits that landlords had in terms of offsetting interest against income, wear and tear allowance, and so on. And then landlords got whacked by COVID when a lot of their properties remained empty. Then they got whacked on the head again when interest rates shot up. So you've now got this perfect storm. You've got a lot of landlords selling their properties and exiting the market. You've got a lot of demand for rental, and hence prices are shooting up. But how can people afford this? What's going on with the rental market?
I always say that rents is always tied to wages.
Yeah.
So because it's whether people can afford it, then they can pay more rents. We actually have another slide on wages growth. Jatin,
We do.
Yeah, I think we've got.
There we go.
So the reason why people can afford more higher rents is because wages have been increasing as well. So remember last year, in the last 12 months, we've seen all the wage rises for civil servants. We've seen the train strikes, and they got pay increases after that. So all of this, the wage growth in the economy, will drive up the rents. And rents, at the end of the day, is the fundamental that support the real estate prices.
Yeah.
Because that is the fundamental. And when we look at any kind of investment, a company, it's an earnings, a real estate is the rent. So that is the fundamental income that comes in. And another reason why it drives up rents, apart from the organic wage growth in this country, is migration. We've heard our PM talk about migration is too high every single day in the news. And just give everyone a perspective why UK real estate market is booming and has been booming and resilient. There's net migration of 700,000 in last year. You can argue every day about or whether property prices are overpriced or whatever. But 700,000 people who moved net, net.
That's net.
That's net, who came to this country and will need to live somewhere.
Yeah.
So let's say
that's about 1%. Let's put it into context.
Yeah, it's 1% of the population.
Yeah.
And put into a global context, Canada, with the space that they've got, the size of the country, they only have 500,000 migration, not net.
Oh, really?
It's just immigration into Canada.
Right.
That's an immigration quota every year, and that's 500,000. And in this country, we're in a small island. To compare our size with Canada, our size of the country, we have a net migration of 700,000.
And a lot of that would go to the major cities where you've got the most, the biggest shortage of homes, right?
Yeah. So that's why real estate prices have been resilient. Rentals have been quite resilient and growing as well, because people are fighting for a place to live.
And you've got institutional landlords coming in where the private landlords have been stepping away.
Yeah.
And there's been a lot of aggregation in that space.
But it's not, I think institutions are coming in, right? But not quickly enough, right? So you've got this...
there will be a lag.
There will be a lag, yeah.
And, the other thing we haven't really talked about is sort of student accommodation as well as sort of international students coming in.
Yes.
Because remember, sort of during COVID, a lot of them were working from wherever they were.
Yeah.
They're back now.
Yeah. And student numbers have gone up. I think it was at about 2 280, 300,000, something. It was like a crazy
And
number.
we expect they'll keep growing.
Yeah, yeah.
And, you know, when we talk about sort of key metros, so take London, for instance, we see, given the number of universities we have around,
Yeah.
a significant number of students that have an impact on sort of rental pricing.
So, I mean, look, if we were going to summarize the position, I mean, if we go back, I mean, actually, this is probably a good one to look at, because summarizing the position, looking at this, rents are still going to go up. I mean, you know, we've spoken about inflation being at, well, the last number was 4%. But if you look at this, rents are still going up above the rate of inflation, or expected to go up above the rate of inflation for 2024, before it then does stabilize into 25, 26, 27. But, I mean, again, from a pure investor perspective, that's actually good news. From a general market perspective, not very good, because I worry when things, it's like price rises. When the market's going up too much, I actually don't like it. As a real estate investor, I don't like it because it creates instability and uncertainty. The only good news from this chart is that from next year, it's expected to just stabilize, right? And stable is good. In fact, that should be the strap line of this presentation. Stable is good, right? That's what we want. Let's talk about house prices, right? So there should be, yeah, there's a nice chart there. House price growth. Who wants to pick this up?
Why don't you start?
All right, so go for it.
No, go for it.
Yeah, no, I think house price growth, as we looked at in the last year or two, like everybody was, like all the investors I've been speaking to in the last couple of months, like everybody's concerned whether it's house prices will crash. Like that's been in the back of everybody's mind in the last year, like at least a year. And I think it's fair to say that the market has proven everybody wrong for a year. Everybody's waiting for a house price crash that didn't come. And doesn't look like it.
Can I just sorry to jump in, but I you know, rant warning.
Yeah.
Because you know why everyone's expecting a house price crash? Because of the press, the papers, they love a good negative story. I mean, it's honestly, if you listen to the press, you'd think the UK is falling apart. Believe me, it is not falling apart, right? And exactly as you said, house prices have not crashed. You can go and look at newspapers from last year that were, you know, predicting Armageddon this year, right? You know, it's not happening. Sorry, carry on.
Yeah, no, it's great. I think it's very, like, I agree with, like, it's media creating the headlines that is affecting people's minds, but also at the same time understand, because everybody looks at the interest rates that affected mortgage rates that went up that much, and then something has to give. That's kind of the rationale behind why people think your house prices are going to crash. But then one thing that people didn't take into account is, apart from the interest rates that risen that much, another thing is the rentals, because of the supply demand imbalance that we just mentioned about net migration and all that is actually keeping rents up. Like, and with rents growing, it means that the yield also expands. The rental yields also expands, even if prices doesn't move. So it
supports the price for
the
value.
There's also a shortage in new homes, which is the other part of that.
Yeah, supply demand.
Yeah, so it's because the key factor isn't just interest rates. It's not just mortgage rates. That is a very key factor.
Yeah,
but then you've got the other factor, which is the supply demand, the fundamentals of the real estate market in itself, and that's why property prices have been resilient, because for one seller who thinks that property market is going to crash, there's another seller got cash sitting there, like being eaten away by inflation, which was running at 10% at one point. And once they need to deploy that cash, otherwise even if they do nothing with the cash,
it's lost
10% of its value. Its value every year.
That's right.
So the smart money will be investing that money somewhere
in an inflation hedge.
In an inflation hedge.
Yeah.
So that's what has been keeping property prices.
Yeah. And the other one was they expected, because of the sort of shortfall of foreign capital we saw last year, that would cause panic. What we really saw is, yes, some of that foreign capital sort of, didn't come in or hasn't come in yet, and they took a beat on 2023. We expect sort of foreign capital to come back in 2024. Now, a lot of that sort of a knock-on effect of, geopolitical issues across the world, as well as sort of a COVID lag.
Mhm.
You know, people couldn't travel, people couldn't do other
Mhm.
things. Now they can.
But also, given all the volatility and uncertainty of the last year and a half, you know, you had the war in Ukraine, obviously everything going on in the Middle East and so on. There's been a lot of people that have basically been sitting on the sidelines because they're saying, you know, let's wait till things settle down a bit before, you know, putting our money back into the markets. And I think what we're seeing, and certainly the general view on the street is they've been sitting on the sidelines long enough. They've been losing value long enough. They want to get back into the market. So 2024 is hopefully, as you know, touch wood, will be a better year with a lot of money coming back in. But if we just have a quick look at the projection, I can see loads of good questions that have popped up as well. Let's just have a quick look at this final bit, which is the the house price forecast. And it's interesting for this year across the UK. You're still seeing the expectation is slight reductions in value. Now, I always say you've got to look at these things in context, right? Everything's very location specific. The type of property, the type of location, and you know whether in a micro environment things are going to drop even as much as this says. And in some areas it will, of course. Some areas it will drop more. But what we find is in high traffic locations where you've got high demand, you know, cities, commuter zones, coastal areas, there's enough demand that actually the prices are not dropping. They're softening ever so slightly, but not collapsing by any means. And certainly where I live, prices are still going up. And I know that because I'm constantly looking for a bigger place.
I mean, what's worth adding there is there's significant demand for new product. So the other things that we have to talk about is energy pricing has gone up.
Mhm.
People are looking for, you know, a better quality flat house. So there is sort of pent up demand for new product. So the other part of this is, while as a whole pricing may go down slightly, we expect price rises for new product that's coming into the market.
Yeah, true. Like energy efficient product.
Energy efficient product, a different design aesthetic, which is the other part.
Yeah. And city centers are back in fashion. You know, it's people want to be within, you know, 10, 15, 20 minutes from work, from entertainment and all of that.
Yeah, and if you don't mind, I answer a very common question that I get from investors as well, like on property prices. When people, investors are very concerned about like, and we see property prices soften, right? Like 3-4%, 4-5%. That's what it is. Like, and it's very important that for investors to understand that that's why we're taking a lending position. Like, and we're not taking an equity position, meaning that we're not owning a property in Shoujan's products. So we're offering a lot of products on basically lending positions, mezz lending, and lending positions mean that we are at a loan to value of 75 to 80%. So sometimes it's very easy that we get pulled into like, oh, what if property price decline? Like, am I going to lose my money? And then it's very important. That's why banks are never worried about them. They're never worried about losing money. Banks. Yeah. Because they are the lenders, they only give up to 60-65% loan to value. For us, we stretch it a bit, 75-80%. Yeah. But still, as long as property prices doesn't collapse by 25% or more,
there's a big buffer.
There's a huge buffer.
Yeah.
Like, because we are not the developers.
The developers should be concerned.
The developers will be concerned.
Yeah.
Yeah.
And actually you raise a really good point, you know, because remember when we're structuring the loans, our thing is risk mitigation and protecting the interests of the investors first and foremost. So yes, while we do that kind of stretch lending, we're in the mezzanine and pref equity space. Every project is stress tested to withstand, you know, 20, 25, even 30% market softening in some cases. And remember, there's also a combination of, apart from the security on the main asset, we usually have personal guarantees on them. And we know that there are other assets in the portfolio of the developer. So if worse ever came to worse, we could actually use some of those to repay the loan. And then obviously sometimes you even use cross-collateralization. So it's our job to over-securitize every single loan so that if there is a 2, 3, 4, 5% softening in the market, it doesn't affect our final position. So yeah, really, really good point.
So because I get asked this a lot, and I think it's in the back of everybody's mind. Yeah. And because I think a lot of investors of Shoujan, in general, like it's not like is not a professional investor in general, like in terms of in the sense of lending position.
Yeah, of course.
So we're learning along the way as well. And I would love to help everyone learn.
Yeah.
And being a lender, that's where the position that helps and secure your capital.
Yeah.
And we're basically like you as a lender basically becomes like a bank position.
Yeah.
And instead of being the developer, you are basically the bank. We're basically empowering, like that's what Shojin is, right?
Yeah.
We're empowering investors to become
the bank
instead of having the bank being an intermediary.
Exactly.
So that's I think sometimes investors need to understand the position.
Yeah. And I'm really glad you raised that, because remember, the reason Jacky and Kirat have joined us is exactly to have these kind of conversations. If you, as an investor, want to get into more detail about any of these topics, that's what these guys are here for, to have those conversations. Come to the office, have a Zoom call, whatever's easiest for you. But it's important to us that our investors understand exactly how the projects work, how they're structured, how the risk managed, and so on, to give you maximum comfort that your interests are being protected. So look, I'm just slightly conscious. I always say that I will never go over an hour, and I think we're at 52 minutes. So I am going to answer some more of these questions. So some of them, I was seeing some of the questions come up, and we were kind of answering a lot of them as we went, actually. But let me pick out some questions here. Okay, Mark, great question. This is more of a general question. This isn't a market-related question, so I guess I can pick this one up. But it's your recent email on progress at the Newquay and Godalming site stated that the Newquay project was underway, but there is still 1.7 out of 2.42 million pound bond available. Are you saying that they started digging with only 30% of the money they needed raised? When will they run out of money if they fail to fill the bond? So no, absolutely not. That's not the case. The way Shojin works is we pre-fund every project. So they got all the money. So there's no risk of them not having the money or running out of money. What we do is we are backed by a family office who provides that money up front so that we can pre-fund the project, so that everyone's, any investors that have already invested there, it all starts working straight away on legal completion. And then we start filling the loan through our platform, and we take out the family office. So the simplest way to explain that, it's, if you imagine a wholesale to retail model, if you buy a box of 50 Mars bars and you put them in a shop and you sell individual Mars bars, basically we buy all 50 Mars bars up front and then we sell the individual Mars bars through our platform. That's it.
That's it. Before you move on to the next question, I have a question from some of my investors I've spoken to. Like, we talked about interest rates, right? So some investors have also asked, like, how do we see in our market, in our space for 2024, on like in the investment products that we could offer to investors, like where the interest rates return for investors will go? Like with interest rates coming down, will it mean that investors' return for the upcoming deals or upcoming projects going to be at a lower interest rate? Or how do you see 2024 for the investment opportunities for investors?
Yeah, I think there's two things to consider. There's rates coming down, but there's also, over time, this will happen naturally, increased competition in the market in which we're in, right? The mid-market, junior funding market. And if you put them both together, because there is more competition coming from other firms, who are looking to encroach into our space, which was always natural because the returns are so good. It's only a matter of time before others come in to try and take advantage of that. So with that, together with interest rates coming down, what you might see over time is a gradual reduction in interest rates. So, I mean, look, one thing I would say is make the most of the projects right now because you are getting good returns. And it's a bit like, nobody knew this at the time, but, when rates were close to zero, borrow as much as humanly possible on long fixed terms because, at some point rates are going to go up, right? So, so in that way over here, we're in a good position right now. I think we will still be very good, you know, for the immediate future, but it is only natural that lower interest rates and more competition will drive down rates for developers, which means it will drive down rates for investors.
Yeah, so yeah, exactly. So the investment products that are available right now are on fixed returns, right? So
They're fixed return.
there's already fixed rates regardless of how interest rates.
Yeah. I mean, the good news is some of the underlying senior loans are variable. So that means that as they come down, it creates more of a cushion for us.
Yeah.
We already stress test all interest rates at a higher level anyway when we make our loan. But if base rates come down, there's more profit in the scheme, which is more security for us anyway.
For example, the new key project that the
Yes.
investor mentioned,
Yeah.
like that's a fixed 18% return.
Correct.
Like throughout for the next 16 months.
Yeah.
Even
16 months remaining on that?
remaining, yeah, there's only 16 months left remaining
Okay.
on it for
All right.
investors to participate.
Right.
Yeah, so these are like these are not going to change because it's already
Yeah.
pre-funded, as we
Correct.
mentioned, and it's already undergoing construction has started.
Yeah.
Yeah.
Yeah. And also, you know, if you take things like Godalming, in fact, I think Mark mentioned Godalming as well. In Godalming, remember that there was a big senior loan and we came in with a junior because it was pre-stabilization on the site. The site has now got PC, tenants are moving in and so on. But the interesting thing was that they had to move it onto a new loan because the development loan had come to an end. But they were moving it onto a new loan when loans were harder to come by. Now, as that situation changes, which we're actually seeing right in front of our eyes at the moment, with a lot more lenders coming into the market, competition, you know, with rates. What I do expect, and again, this isn't, you know, I'm not saying this is definitely going to happen, but what I do expect is within the next few months, they should start looking around for that refinance because they should be able to lock in lower rates and they should be able to get the higher leverage they need to take out both the senior and us. So, you know, this year will be interesting, you know, certainly with a lot of that money coming back into the market, a lot more kind of confidence coming back into the market, you know, we expect this kind of activity to help. So if you are interested, you know, Godalming's a great one because it's a finished scheme, right? So that's definitely one worth looking at. Right, I'm conscious of time. So I'm going to, and if you have any other questions, we will try and email you directly. I've got all the questions here, and apologies we didn't manage to get to all of them. Let me pick up one more. Joanna, interesting question actually. Do you anticipate any new projects abroad with interest rates of 20% plus, like the one in Malaysia? Now, the one in Malaysia was a test drive for us for two reasons. One, to test appetite from our investor base. Two, to also test how we would manage an international project. But it wasn't development. It was buying finished units off plan and then selling them into the Hong Kong market. We have seen that the sales got delayed in the first year because of continuing COVID restrictions at the time. So that project has gone on longer than we wanted it to. It's still a fantastic scheme, the building and so on, but it hasn't delivered in the way we wanted it to deliver. So for the moment, we're not looking to do any more of those. However, that is not to say that there may not be things on the horizon. And just to give you a little sneaky peek, you know, we get approached a lot by international developers, and we generally say, no, we're very UK focused and we're not ready for the international markets. There have been some really good opportunities presented to us recently, which have a very low risk factor in an international market in Dubai. Now, I'm not sure if we will do it, but if we do, that would have those type of returns, and it won't actually involve development risk. But we're still in two minds about that. If we do go in, we'll go in a very small way to test it first. But other than that, you know, there's no other international markets we're really focusing on right now, but we will keep you posted. It is in our pipeline, like a long-term plan, but certainly not over the next few months.
One thing I think we've discussed as well, we probably could share, like, is if we go abroad, we'll make sure that we'll have a local partner that has this experience local partner to partner with, like, that's one of the criteria that we will consider before we actually consider it. So,
Yeah, definitely. I mean, with all of this, even Dubai, right? The idea is a very established, experienced local partner to do the project on the ground, and also experienced partners that can help oversee the projects.
yeah, and because at the end of the day, like, capital is chasing for returns.
Yeah.
And like for our investors, for us, for everyone. And if UK market can deliver 20% or close to 20%, 17-18% returns, let's say Narrowcliff, Kanuki is 18%. So if UK projects with the risk, with a relatively lower risk than the emerging market project, so and it still delivers close to 20%, then we don't really need to take that risk abroad in an emerging market. Because at the end of the day, developed markets like UK for a reason compared to emerging markets, because legal structure is safer. There is a lot more foreign capital wanting to
relative
move in.
liquidity in the market.
Relative liquidity, international capital flowing in, and so on and so forth. Like price stability that we discussed, interest rates stability that we've discussed. These are all key factors that drive real estate, and UK, US, Europe are developed markets for that reason.
Yeah.
Right? So it's proven model.
Absolutely. Yeah. For the sake of a few percentage points, I would stick to this market. I think if I was looking at an international project, certainly in a developing environment, I would be looking for a substantially higher return for investors. So Joanna, I hope that answers your question. And I do apologize. There are so many good questions here. We're going to have to respond to them all individually later, because we have run out of time for today, I'm afraid. But look, we're hoping to kick these off on a regular basis again. So, if you have, questions or anything, send them in and we'll pick them up at a future one, or we can come back to you on an individual basis. And once again, do not forget that, the team has expanded so that we can talk to investors more. We can spend time with investors, answer questions. So please do reach out if you need anything at all. Thank you to Jacky and Kirat for joining us today. I think it's been a fun discussion. I hope you guys have enjoyed it, and looking forward to the next one. Please do join us next time. Thank you.